Good afternoon, everyone. In the interest of time, we might get started now. Firstly, I just wanted to highlight that recording of these slides and the audio recording will be made available to you all. And for those that have registered and not able to attend now, will also receive a copy of that too. In the corner of this application, there's a dialogue box, so you're able to ask questions and comments. A few of you have already actually started making some comments and questions, so thank you for that. Before I also start, just on the next slide here, I just wanted to highlight that this is general information only and does not constitute personal financial advice. It doesn't take into account any particular person's financial objectives, situation or needs. Well, thank you all for joining us for the BetaShares webinar, Your Window to India. We have a very large number of clients that have dialed in, many financial advisor clients of ours, so thank you for joining us. And we have many self-directed investors, individual investors, so a very warm welcome to you. We also have a large number of people from the Indian community and people of Indian origin, so I have a very special message for all of you. Namaste, मेरा नाम विनीत वडेरा है. आपका धन्यवाद और स्वागत है. मेरा जन्म हिंदुस्तान के लुधियाना पंजाब में हुआ. मैं ऑस्ट्रेलिया में 40 साल के रह रहा हूँ. मुझको बहुत खुशी है कि मैंने इंडिया इन्वेस्टमेंट फंड आपको बताना चाहता हूँ. मैं सभी को अपना इंडिया होने का गर्व है. इंडियन इकोनॉमी में बहुत सारी रोमांचक चीजें हो रही हैं जो मैं आपके साथ शेयर करना चाहता हूँ. हमारा भारत का वक्त आ गया है और आप सारे इसके हिस्सेदार हैं. धन्यवाद. I'm also joined by my colleague here, David Bassanese, Chief Economist.
Very good to be with you, Vinny, and very impressive Hindi skills, language skills, I must say.
Oh, thank you, David. I have a few other skills. In fact, I've already had some comments coming through from people I know correcting my grammar, and also one commenting my Hindi has a very strong Aussie accent. Okay, before we start on the agenda, we just want to take one poll question, please. So the question that will pop up on your screen here that we're just hoping you can answer. And the question quite simply is, how familiar are you with the Indian economy? So if you can just, many of you have actually started voting there, so thank you for that. Great, thank you. So in terms of the agenda today, there are really 3 agenda points that we're going to cover. The first one is India's long-term growth outlook. The second is the current economic situation and the opportunities. And the third one is the BetaShares India Quality ETF and some features of that. We'll start with the first section in terms of the long-term growth, and I'll just make some high-level comments before I hand over to David, who's going to share some analysis with you. Now, in terms of the Indian economy, it is now the 3rd largest economy in the world. It's the fastest growing too. The forecasts are for 7.6% compound growth or annual growth, and that's well above the general global economy in terms of its forecast growth of 3.6%, and even China, which is sub 6% now. India has a functioning democracy. Now, democracy itself, as we've observed, reforms and policies may not move as fast, but democracy, we also know, brings a lot of plausibility to it. India also, as a country, has English as its 2nd language across the country, so that can also help with doing business. And it's a major exporter of technology services too. Many of the large companies like Tata and Infosys fit in that category. And India very much is a consumption story, and a very much domestic consumption story. So in terms of the unique attributes and opportunities, we've really segmented them here in these key categories. The first one is age demographics. India has a very large proportion of its population that are young and at a working age, which has a competitive advantage. Digitalization, what we mean by that is it's an economy that's moved from being an agricultural-based economy to a services and IT-centric economy. And interestingly, it's done this without necessarily going down the manufacturing route, so being the factory of the world. There have been some significant financial developments. This really is on part of the reform side. And the two big ones here are the goods and services tax, which have now become unified across the nation, as opposed to individual state taxes. So it's previously been a hindrance for business, and that really has been an efficient way now for businesses to operate. And the new bankruptcy laws that were introduced recently, whereby lenders can actually directly auction assets from those companies that are in bankruptcy. So what that means is that lenders have more security over the assets and are more amenable to lend to businesses. And lastly, there is some US $1 trillion of infrastructure projects and commitments in place. Some 50 new regional airports, upgrade of motorways, metro systems. I've been to Delhi recently and have navigated Delhi in the metro system. It's very, very efficient. And a new dedicated freight corridor between India and Mumbai. I might pause there. Dave, if you could please add just some more details on what you've sourced in terms of demographics in the Indian economy.
Thanks very much, Vinny. And yeah, look, this is really an incredible growth story, India, as you'll see from some of the following statistics. So, for example, if we look at the UN population projection, their latest report that came out, the India's median age is about 28 years, or is around and likely to be next year. That's the current forecast, which compares with about 42 years globally and 38 years in China. So, a significantly younger skew in terms of the population. Also, overall population growth expected to be relatively strong by global standards also. So you're looking at something like just under 1% growth over the next decade annual per year. But again, compared to, say, China, the other sort of well-known growth economy, basically looking at close to flat population growth in China over the next decade, 0.2% a year versus 1% growth in China. So a younger population that is growing more strongly than China. And just some more information on that, just to, again, highlight that point. If you look at the next slide, again, just breaking down the age profile of the Indian population vis-a-vis, countries such as China, Australia, Germany, and again, as you can see, a greater proportion of India's population is in that younger age cohort, so children, teenagers, younger workers. So India will be less subject to the population aging challenges over the next decade. So it really is setting itself up for good potential growth if it can, keep its economy going along pretty well. Just on that also, I mean, not only the demographics, I mean, the other aspect of the Indian story, as you can see from the next slide, is the strong catch-up potential. So if you think about something like GDP per capita, it's something like around $8,000 US, which is less than half that of China's, which is now close to $18,000 and well below that of the United States at $65,000. So again, that means that there's a lot of growth catch-up, in terms of being able to grow GDP relative to population growth and get up to sort of closer to even just getting to China's level. It means a doubling in GDP per capita. And just another highlight of how that growth, that increase in GDP per capita may come about. 34% of India's population as of last year lived in urban areas versus 60% in China and 55% across the world. So that urbanisation has been a great growth dynamic in China over the past couple of decades as you're getting low productivity agricultural workers moving into the cities, taking up manufacturing jobs and services jobs, and their productivity increasing accordingly. So that's something that has benefited China greatly over the past few decades, is still ahead of it. India still has that growth potential ahead of it. And just to re-emphasise that story, here's another interesting visual if you just change the slide. Looking at GDP per capita and the sort of dynamics of how, as countries that start with a low GDP per capita tend to be able to generate relatively high growth in GDP per capita as they, go down their development path. So you're seeing examples there of Japan, Korea, and China over the last few decades. And so if you look at it, India is now in that part of the GDP per capita gap, between 5,000 to 10,000 US dollars per capita in today's dollars, where growth can be pretty strong as living standards improve and their productivity moves toward global standards. So it's really in that sweet spot in terms of good growth potential over the next few years. The other element, just moving along to the next slide, and again, something that Vinny touched on, the political reforms. I mean, India is a democracy. Again, unlike China, unlike some other countries, developing countries, it does have a relatively stable political environment, often not pretty to watch. I mean, many democracies aren't often pretty to watch sometimes, but nonetheless, it is relatively stable in the sense that it already does have democracy. And slowly but surely, the current Prime Minister Modi, who's now in his second term as Prime Minister, is embarking on reforms. I mean, we've mentioned the GST, the big infrastructure programs that are going on, looking at, so some of the objectives there, doubling the length of national highways, improving the transportation links across India, electrification of households. Again, this is another project that is being rolled out, increasing the number of airports, as Vinny mentioned, and also just ensuring up the fiscal position of India by move toward more digital payments, better identification systems to help reduce, still lingering corruption and tax evasion. The sort of things that do blight many developing countries. India is trying to tackle that through reforms, which does bode well. Summing all that up, if you look at it, this is a projection from the International Monetary Fund, the World Economic Outlook in April, and it looked at growth forecasts between, growth forecasts between 2016 and 2024. So you're looking at India expected to grow at annualized rate of about 7.5%, whereas China only now expected to grow by 6%. So 6% is pretty good, but India, again, because of those demographic reasons that I mentioned, because of that low GDP per capita and that productivity potential, is in a position where it can and should be able to grow more strongly than many other countries over the next decade or so.
David, before we go to the next session, a few comments and questions have come through, and I think we might even just take one or two of them now while we go through, because it's relevant to the topic here. The question around urbanisation, is it tracking going to significantly differ to China? Look, the only comment I'd probably make there is that the Chinese urbanisation was really state planned, whereas with the Indian urbanisation, it's really the population moving to where the jobs are and where the growth is. Mm-hmm. That might take longer and slower, but there's more plausibility in those changes. Good. Anything else to add, Dave?
No, I think that's right. It's going to be a more market-driven movement. So presumably they'll go to the most productive areas available, and you've got private sector generally gets that more right than the public sector. Mm-hmm. So yeah, it may be slower, somewhat slower, but it's certainly ahead of it to go down that path.
And the other one that's come up is, well, all of these young people in India will need jobs. So any comments on around unemployment rates in India and any spikes?
Look,
that might destabilise growth?
Look, we'll talk a little bit about the economic situation in a minute. I mean, it is true that growth has slowed somewhat over the last year, which I'll get into in a minute. But as with many countries, unemployment is a challenge. But I mean, India, as has been mentioned, is a major technology exporter. And that services sector, in the way that China has been a workshop to the world. I mean, it's a bit of a cliche, it's been used before, but in the way that China has been a workshop to the world over the past decade or so, India is really shaping up to become the service, the back office of the world, if you like, in terms of technology. So, I think they should be, and the other thing in their advantage is the fact they're generally well educated, by developing world standards. and they already speak the global language of capitalism, which is English.
Very true. Great, let's move on to the second part of the presentation, which is the current economic climate in India. So Dave, look, and we've had some questions coming through also on this, but there has been a recent slowdown in the Indian market. If you could just share the current status and why the fundamental drivers of growth are all still in place.
Yeah, thanks, Vinny. So if you just look at the first slide, here's a history of Indian GDP. And as you can see, it's been running really for the last few years at a pretty solid pace of around about 6 to 7%. As of June last year, annual growth reached a top of about 8%. But since then, it's slowed down. In fact, we just got the latest quarterly number had annual growth in the June quarter slowing down to 5%. Now, there's a couple of reasons. Well, there's several reasons for that. Firstly, some domestic reasons, and there is I guess the demonetisation process that happened a couple of years ago, where they basically, outlawed certain types of cash and wanted to convert it into new bills. Did disrupt spending for a while. Many people tried to, convert their cash to put it into the bank, and they couldn't get money out of ATMs as quickly as they used to. So that has been a disruptive influence. And that transition is playing out as well. Probably more importantly, there's also been a credit growth slowdown. And again, there was a big boom in lending and in recent years, and there's been some bad debt accumulating on bank balance sheets and also in non-bank areas. And we've seen a tightening back in credit conditions, which is, again, in areas such as car demand, car sales have slowed over the past year. Also, as many countries are, India, and I'll talk a bit about this later, has been caught up with the trade wars a little bit, so export growth has slowed down as well. But again, it's by other standards of other countries, India is still holding up reasonably well in terms of that growth slowdown. Now, why, the outlook I think is still pretty encouraging. Firstly, the monetary authorities have responded, so you have seen interest rate cuts in India over the past year, and that could well continue. And you are seeing the tightening in credit conditions, the clamp down on bank lending starting to ease somewhat as well. What also bodes well for policy is the fact that, if you go to the next slide, is the inflation rate. Again, by global standards, by world standards, Australian standards, inflation in India is high. It's certainly higher than what we see in the developed world, but by India's own historic standards, it's actually come down to quite manageable levels, quite attractive levels, such that it's allowing the central bank to be able to ease policy on the back of low inflation. So if you see the core inflation measure there, taking out food and fuel, it's slowed back to a 4% pace. The headline rate over the last few years has now slowed to under 4%. Which is close to the central bank target. So they've managed to tackle their inflation problem, and that bodes well for the central bank being able to provide policy support as need be.
Great, Dave. Thank you for that. Let's now move to the BetaShares India Quality ETF. So look, we spent a lot of time in terms of analysing, researching the Indian market on how best to deliver that exposure for Australian investors. And one thing that was very obvious was that it is probably one of the most concentrated stock markets in the world. We're a handful of companies, mostly some big banks make up a large part of the market capitalisation. Many of those banks obviously, have varying degrees of state ownership. So the investment notion is what's popular and big may not be the best investment for you. What we sought to deliver here was a diversified portfolio of high quality Indian companies. And you can see on this page just the diversified nature of this fund. Between the big segments of consumer, staples, information, technology and financials, it's pretty well balanced and diversified. And what's very interesting that over the last 20 years or so, the Indian market has grown some eightfold. And looking through that, it's really the mid-cap space that has delivered some 14 times cumulative returns over that period. So we sought to deliver a diversified, as we said, high-quality feature of the companies that are in this portfolio. Dave, could you share with our clients here a little more on this strategy?
Yes, thanks, Vinny. So, so that's some details of the ETF there. If we just flick to the next slide. So again, as Vinny mentioned, the challenges, really the Indian market offers both challenges and opportunities. I mean, the challenges, as Vinny mentioned, relatively inefficient market. Well, it's inefficient in the sense that a good active management or sensible screening, quantitative screening, we think can allow you to beat the more traditional market benchmarks, beat the overall Indian market. So that's really how we've gone about it. You can actually go with an active manager if you wanted. There are good managers, but some of them are quite expensive. But we found that a better value proposition to deliver good returns to that market is through a smarter indexing approach. So we've done that rules-based quality focus, achieving a couple of areas. To skew the composition of companies more toward that get a bit more mid-cap exposure and avoid some of the more top-heavy exposure than you otherwise get. And also that helps to reduce the single sector and stock exposure as well. Now, so that's part of it, but the other important part is this screening for quality. And if we just go to the next slide, and again, so what we've done, this index is basically, what we do is we scan the Indian market and we identify the companies with the highest return on equity. And again, assuming they meet some other criteria such as not having too much debt, having reasonable stability in earnings over the last few years. And they are important to suggest not only is the current return on equity high, but is likely to be sustained over the next few years. So high and sustainable return on equity is important. And really, this is one of those, why is Warren Buffett in this slide, you might ask, is because return on equity is one of the key criteria he uses in selecting companies. And the reason for that is that companies with high return on equity generally are able to deliver high earnings growth per share over time because, they're generating a lot of profits relative to their equity, which in turn, if you're generating high earnings per share over time, you should be able to deliver a pretty good share price performance over time. So that has been the key driver of the smarter beta approach that we've used in developing our index. With that, I'll hand back to Vinny with some more stock-specific information.
Yeah, look, I might just highlight a couple of stocks, and these are stocks that are in our index and ETF that really meet the highest quality measure of the stocks based on the criteria that we have. As I said, rather than just what's popular or big. And they're stocks that wouldn't necessarily be in some other indices or at a very low weight. The first one is Avenue Supermarkets. They have a chain of supermarkets across India called D-Mart, particularly in the north of India. And they are one of the most profitable grocers in the world. They have a phenomenal growth story. In fact, they plan to double the number of grocery stores that they have from their current base. Looking to open another 150 stores, and they currently have 164. And these are based both in urban and rural areas. When we talk about India being a consumer story, a large part of that is retail. And interestingly, in India, the large part of that retail component is groceries, which make up 62% of that segment. So we're talking about staples here, and this company in particular, D-Mart, has got some great growth potential. They really do focus on that consumer staple story, and their tagline that they promote themselves on is everyday low prices. In terms of some of the metrics, I mean, this stock was listed, Avenue Supermarkets was listed in March of 2017, and since then it is actually up some 400%. It has, based on the quality measures that our criteria based on, it has an ROE of some 17%, has very low debt to equity, and most importantly, its forecast EPS growth is around 28%. So that's Avenue Supermarkets that run the D-Mart grocery stores. And the other one I wanted to share with you quickly is Godrej. This is a company, is a consumer products company that manufactures things like soaps, shampoos, a lot of household and consumer goods. Some of their brands are leading in the categories, particularly things like shampoos and soaps and things like that. There has been a recent pullback in the share price, but they have very healthy fundamentals. Their ROE, again, since they were first listed back in 2015, they're up on an annualized basis some 35%, and Godrej's ROE is just shy of 21%, and they have an expected EPS growth over the next 3 years of around 11%, and over the next 5 years of around 25%. So just some key examples of, as we said, and I really wanted to highlight ones that really are at the highest level of our quality criteria. Dave, I'll let you share a little bit more on the performance of the Indian market and the index that our ETF tracks.
Thanks, Vinny. Yeah, so as you can see from this slide, so the index that so the IND ETF tracks an index. As I said, it's an index of the Indian companies with the highest quality scores based on our quantitative screens. And as you can see, historically, that index has really shot the lights out in terms of its performance vis-a-vis not only other emerging markets, but world markets. So just to put some numbers on that, since June 2008, the annualized return up until the end of August has been 12% for that index versus 6.7% for the global market, global MSCI index, and a miserly 4.5% for overall emerging markets. Over the past 5 years, it's had an annualized return of 13% versus 7.3% for the global market, and again, only 4.3% for emerging markets. So India is part of emerging markets, alongside China, Russia, Brazil, all these sort of countries, but it's really been one of the standout emerging market performers over the past decade or so for all those various growth reasons that I've mentioned. So very good performance under its belt. Of course, the old proviso, past performance is not necessarily an indicator of future performance. You take that on board. But again, I think for the reasons that we've outlined, that certainly the growth potential of the economy and some of those high quality companies within that economy, does certainly bode well for potential future good returns also. Now, another important feature of the index, the India index, if we just go to the next slide, and this is true of the Indian market in general, and it gets back to what I was going to mention about the trade wars. Not only has India performed very strongly over the past decade or so, but the correlation of the Indian market with global markets is relatively low by other standards. So India, because it has a strong domestic focus, it has a strong consumer focus, and it's not as tied up in global production chains, trade chains. The correlation of its market is somewhat less. So, for example, the correlation of monthly returns since mid-2008 vis-a-vis the global markets has been 0.42, whereas in the case of Australia, for example, the correlation is 0.57. And in fact, India, the index that the IND ETF aims to track has a correlation with Australian shares over that period of only 0.33. So again, it's giving you very good diversification within a portfolio because of that low correlation. And just a question in terms of the trade wars. I mean, again, one of the features of India is that, look, all countries are being subject to the trade wars to some extent, but India is relatively insulated and two stats just to back that up. Overall exports as share of GDP is something like 20%, versus, say, in some of the other Asian economies, closer to China, Korea and Taiwan, for example, exports are around about 40%. So India has half the export share of GDP going, or half the share of GDP going into exports to some other Asian economies. Now, the other feature also is of the exports that India, the value add, the foreign value add within Indian exports is also relatively low by global standards, and certainly by the standards of other Asian economies. So there's a low, in other parts of Asia, for example, a lot of lower cost Chinese imports brought into their country, and then they are part of the manufacturing value add that then goes into the exports that Korea and Taiwan and whatnot then export off to, either export back to China, export to Europe, export to the United States. That sort of Indian, low-cost Chinese value add is less evident in India, so it is relatively more insulated within the global, value chain, so to speak. So another important feature. Now, just to conclude, just on valuations, again, it's all well and good to have a great growth story, but I mean, if it's already priced into the markets, then, maybe it's not offering that much value. But if we just go to the next slide and look at valuations, we don't have that slide.
No, why don't you just talk?
Oh, yeah. No worries. So just to give you a question that may come up is, how is the market valued? So the market is trading at a price to earnings ratio at the moment of about 18 times earnings, which is a little bit above its long run average of 17 times earnings. But by global standards, that's how the Indian market is trading vis-a-vis global markets. That's in line with its long run average, because even PE ratios globally are a little bit above their long run average. More importantly, on a price to book value, because PE ratios can bounce around depending on what's happening with earnings, but a more less volatile measure of valuation, price to book, it's trading at 2.55 price to book as at the end of August, versus a long run average since mid-2008 of 2.84. So that's a 10% discount on a price to book ratio. Now, at the same time, I'd note that the price to book value for the global market is at a 13% premium at the moment. So valuations have been pushed up globally. What all that means is that the Indian market, it normally trades at a premium to global markets on a price to book basis. And at the moment that it's trading well below its typical premium to global markets. So the long run average, it's traded at a price to book of about 45% above global markets, and at the moment it's only trading at 17% above global markets. So, so relative to global markets, is actually looking at worst fair value, and on some measures such as price to book is actually looking relatively cheap.
Thank you, David. Then on that, we might take questions in a moment, though I think you've answered a few of them relating to trade wars and just current valuations, which is great. I should just highlight, so what we've covered here today, things to consider also. This fund, the BetaShares India Quality Fund, like any global equities fund, has investment risks. We've highlighted them there also. Again, we highlight this as general information only, and doesn't take into account any of your personal circumstances. And please, if you would require any further information, we do have a PDF document that's on our website, but please feel free to contact us with any information. We have a few more other questions here that we might just cover relating to sort of fees and MERs. So the total fee on this fund is 80 basis points. That actually, from our understanding, is the lowest cost fund when you compare it to other types of passive funds or even active management funds. It is important with any fund to look at the total fee. So that is the MER and also the recoverables. We quote ours as a total fee, which is 80 basis points. There's some questions here around, do we hold the stocks? Yes, we do, absolutely. In fact, the entire stock listing is on our webpage. So this Australian domiciled fund holds all of the stocks directly. And total transparency, as with an ETF, they are published on a daily basis on our website. We've also got some questions here relating to the ETF itself and how this is different to some managed funds that you may have reviewed also. So in nature and structure, it is a managed fund. ETFs are managed funds, and we have a lot of information again on our website, and we're happy to send it to you based on the questions you've asked on the benefits and advantages of an ETF. But an ETF is a managed fund, a unitized managed fund. How you access the units is different. You're not filling out an application form or necessarily having to go through a platform to access the fund. It's as simple as a share trade on the ASX. The ticker code for this fund is IIND. We've abbreviated that to IND, but the ASX ticker code to invest is IIND. Maybe some other questions around the fund pays income. Yes, as a unitized fund, on an annual basis, all income that's received in the fund from dividends of the underlying stocks are distributed. Another question here around currency hedge. No, the fund is not currency hedged. David, did you want to make some comments around the benefits of unhedged for Australian investors? So we're actually picking up the rupees growth too.
Yeah. So in terms of the Indian market, I mean, you can obviously go unhedged or you can go hedged in this case. But I mean, again, it's a developing market, strong growth potential. There's probably good scope for the currency to appreciate over time as well. So you may well get sort of a double whammy return in that sense. If the market does well, plus the currency doing well, you know, that's certainly a consideration, and you know, one of the reasons we thought to go unhedged in this case.
Great. Look, we've got still a whole lot more questions coming through. What we will promise to do is that for each question we will reply back to you all from our client services team, and we'll do that in the next day or two. I just want to say thank you to our, as I mentioned. Lastly, we'll just share the results of the poll here. So at the beginning, many of you did participate in this poll, the question of how familiar you are with the Indian economy. 34% was very highly knowledgeable about the Indian economy. 32% somewhat, and 64% not at all. So we trust that we have provided you with the information to be more knowledgeable, particularly around the investment opportunities for India. Please have a look at our website. We will send you copies of these slides and our audio recording. Greatly appreciate. And again, for my Indian Australian friends that have joined, I just wanted to say मुझको बहुत खुशी है आपके साथ ये इंडियन इन्वेस्टमेंट फंड की बात करनी है. हमारा भारत का वक्त आ गया है and आप सारे हिस्सेदार हैं. धन्यवाद and thank you everybody.